Wingstop investors got their wings today. The restaurant chain reported first quarter financial results that included an increased forecast of global unit growth from the 14 to 15% range to 16 to 17%. Does that mean that Wingstop has clear skies ahead, or could the shares come back to their nest? Today we'll be taking a look at the chart on Wingstop to see if there are clues as to what the intentions of the big money are. The first thing we're going to do when we take a look at the chart is we will assess the trend, and Wingstop shares just formed a W bottom, which is often indicative of the start of an uptrend. Wingstop also broke through a meaningful resistance level in the 247 price range, which is also indicative of the start of a potential uptrend. But we're not going to chase Wingstop here in the 264 range, just assuming that we're going to keep rising at its current torrid rate. We'd be looking for a pullback, perhaps to the breakout point, for a bounce before we would head higher. There is also a clue here that there are sellers waiting with more sell orders here in this resistance level. So Wingstop is currently working its way through that level, but we could run out of steam and pull back, test that breakout point, and bounce off that level. Now, if Wingstop shares do continue higher, we'll simply miss the trade. Nothing lost. But our game plan would be for Wingstop to do something like this, to pull back to the breakout point, bounce off that level, and then work our way through this resistance before heading up to the next resistance level, which we have here in the 301 to 309 price range. So our game plan would be to wait with a buy limit order in the 247 price range, protective stop not much lower than that, for a bounce trade to work its way through that resistance level before Wingstop shares heading closer to the 300 plus price range. So that's today's trade setup. Hope you enjoyed the session. We'll be back with more chart analysis in future sessions here on YouTube with Equity Empire. We'll see you then.